Hey, Sam from Teach the World to Trade. Got a big one today, module number 7, trade execution. So this is where we start putting our money where our mouth is. We go to market and we put on the trades that we've identified. A lot comes from trade execution, very, very important part of the process. This and trade management, where a lot of psychology comes into play. It's where we take action. So we do all the hard work, all the groundwork, all the foundation. We stop being an analyst, which is a whole role and a whole industry in itself, and we become a trader. Okay, that's where traders are made, through execution and management. So enjoy this module. It'll get you a little step closer to understanding those foundations of the trading world. Okay, enjoy and see you on the other side as always. Trade execution, module number 7 in this foundation series. Going to be looking at entry, exit, and stops. Execution really is where you turn that analysis, you turn all of that hard work into action. It sits bang in the middle of our trading process. You know, we've got our preparation phase before we start getting into our analysis and identification phase, and then action stations. We put our ideas into fruition and we execute those ideas on the markets, to which you have to manage. It's a little bit of a combination. Management has its own part, its own pillar of the process, but it's very much linked to the execution. I'll probably say this more than once on this module, but traders that I've known to succeed in the world are made through execution and management. I can teach anyone to identify trades. Hopefully you'll be a bit closer to identifying trades already watching these last few modules on the execution series. But absolutely, traders, successful traders, are made through execution and management. I'm not saying you don't need to identify and evaluate very important pillars, but execution and management is the difference. And we'll, through this and maybe the next couple of modules, you'll understand why. Core components of trade execution. Like I said at the start, you've got your entry. You've got to get into the trade. This is where you get into that trade. Execute your entry. Once you're in, you've got to know where you're getting out. You've got to know your exit, where you will get out if you are right. This is very important. A lot of people miss this. I mean, for me, obviously, trading and teaching trading for so many years, these are just second nature to me. But for a lot of people that are new to trading, they don't consider even where their exit should be. In fact, I had a conversation today with someone at the gym. I was talking about this foundation series, and they said that very same thing. It's like, well, I've been looking at stocks and shares, but where do you get out? I'm like, that's the point. You need to have a plan. It's part of the process, part of the plan. Have an exit in mind. And a stop loss. If things go wrong, if you're not right, which chances are you're not going to be right every time, I'm afraid, bombshell. I've come to terms with that myself, that I'm not going to be right every time, but you need to know where you're going to get out if you are wrong. Okay, you've got to understand those 3 core components of every executed trade that you need: entry, exit, stop loss. So before you even enter, you've done all your hard work, you've identified a trade. The execution is where you take on that risk, where you assume financial risk. Well, many psychological risks, etc., duration risk, many types of risk, but it's where the risk starts, the real risk. And you've got to think, why am I entering? You've got to ask yourself lots of questions. Make sure, I work with checklists, tick sheets, whatever you want to call them when I'm coaching people. And these things are very important. Why are you entering in the first place? You've got to understand why you're doing that. What invalidates the idea? What has to happen for me to be wrong and for this idea to not work? Very important to understand these things as well. The duration of the trade. I work a lot around this subject with myself, clients, people I'm educating, and you've got to understand, when you are putting a trade on, you're investing time, effort, and money into that trade. And you want to know how long that's going to take to then calculate that into your returns to see if it is all worth your time and effort. And then does it align with your goals? Does the trade get you closer to where you want to be as a trader or investor? Very, very important. And I have to myself bring it back to my original goals and double my outgoings every year. Will a trade impact that greatly if it goes wrong? You've got to think of the downside as well as the upside, right? It's very important. And will it get me close to the goal if it's right? Risk reward. We spoke about that in our risk module. So moving on to order types, another foundation and a must-have when you're talking about execution. On a basic level, you've got to understand what a market order is. When you're putting in a market order, it's an order that goes straight to market. It guarantees your order gets filled, but it doesn't guarantee the price. Okay? Guarantees that you get your position on, but it doesn't guarantee what price you get it on. It just gives you the best market price at the market on the bid or the offer. Market order. Now, a limit order is a guarantee of the price, but it's not a guarantee of execution. So you can say, right, I want to get in at 10, and you put you want to buy at 10, you put your buy order at 10, a limit order, but the market might be trading 12, 13. So the market's got to come to you down to 10 to fill you at 10. So you'll definitely get filled at 10, but it's not guaranteed. The market has to come to you. Okay. And your stop order, market order, limit order, stop order. And you can have a market stop or a limit stop. So you can have a market stop that gets you out, but the price isn't guaranteed, but getting you out is guaranteed. Or then a limit stop where the price is guaranteed, but the fill isn't guaranteed. Okay. Think of it in that purpose, in that sense of guarantees and non-guarantees. With the limit order, you have more control over your kind of trade setup. If you buy at 10, you want to try to get 15, get out at 15, you're going to stop out at 8, your risk reward. But if you've got market orders, you might not get filled at those prices. It might mess things up, but you will guarantee to get in and out. Okay. And this is part of the practice of trading, which I'm going to talk about at the end, which you need to experiment with both of these, limit and market orders. Okay, managing execution risk. You've got to think about liquidity. When we talk about market orders, if the market is very illiquid, you might get what we call slippage. So you might be trying to say buy at 10 to stop out of a position, but then you might get filled up at 15 because there's no liquidity between 10 and 15 and a widespread. That's something you've got to consider, the liquidity risk when you're executing, because that then, as I mentioned, gives you the slippage, that not the best prices that you'd want to get in and out of your position. And market volatility, when a market goes extra volatile, I think we've seen many markets be volatile in 2026. The precious metals being a core group, where when you've got this high extended volatility, it makes execution a lot harder because the market's moving so quickly and there's less liquidity. So there's a lot of slippage. And then you've got the management risk when you're onside, when you're offside, and when your trade's not moved anywhere and it's around what we call a scratch. We call a scratch when you buy and sell at the same price. So when you're onside, it means, say, you've bought at 10 and the market goes above 10 and you're essentially winning. And offside is, say, you buy at 10 and the market goes 9 or 10 or below, 9, 8, 7, and then you're offside and you're losing. Onside winning, offside losing. A scratch means you're at break even. That's some trader language for you, onside, offside. And then it's managing that risk and having a plan for when you're onside, when you're offside, and when you're hovering around a scratch. The professional response to managing that execution. Always avoid impulse changes when you're around the point of execution. It's very important to have that plan set and follow through that plan. Don't move your stops emotionally. Don't just think, no, I hope it comes back. I really need it to come back. I'm going to move my stop so I keep my trade on. That's a cardinal sin in execution. Chasing prices, or I wanted to buy at 10, now the market's at 15, or I'm just going to buy 15s because you're chasing it and you want it to be long. You've just given yourself five ticks spread there. And what you should be doing is reassessing the trade. For example, is trading buying at 15 still valid, or does that go against my initial trade that I had identified? Stick to the plan, like I said there. Stick to that plan. It's very important. It stops you chasing prices, stops you being emotional, stops the impulse changes. Do all the hard work, preparation, identification. Do all the hard work there. Then it should make execution easy. Our exits and our stops. So with an exit, when you've got a position on, and you've done all the hard work and identified the trade, and you've entered it where you want to enter it, you've got to have that structural target where you believe you can get out. It could be based on time, it could be based on technical analysis. It could fit in with your goals. I need to make or want to make X from this trade, so this is where my exit is, and it's got to be valid as well. This is one cardinal sin from junior traders and retail traders is they have they're living in fantasy land when they have their profit targets for a lot of these trades, things that haven't traded there in many months, and their duration and profit targets are way out of kilter. So making sure that it's kind of valid in the right time scale, that you're going to keep the trade on. And for your stops, it's an account protection mechanism at the end of the day. Old school risk management says you shouldn't risk more than 2% of your account on any one trade. I work with expectancy and various other risk reward ratios, but essentially I always protect my own account. That's the number one rule for me. And never have a bad day that you can't have the equal good day. Same as a bad month. Don't let a bad month be worse than a good month. Those sorts of things. So, and I get that from my own experience. And you as traders, when you get your experience, you'll understand more about your stops and your exits and your risk reward ratios. You've got to define that stop before entry. It's very important. There's nothing worse than being in a trade and it's going against you, and then you've got to think about stops and having the right stop level. If you have it predetermined, it's all part of the plan, and you understand that, then you just have to roll through the plan. And stops, they're not a personal failure. They are a guarantee in trading, and welcome to trading. Essentially, it's going to happen to you. You will lose money, but our job is to have more winning trades than losing trades, and have that expectancy set at a higher level than our losses. Professional standards. Execution is the difference between success and failure in trading, and something that us traders practice all of their trading careers. For me, execution now, because you can put timing in there, you can be right. It's a job and a career that you can be right and wrong so many times because your timing is just off. And this is a big thing in trading. So many times I've called the market right, but I've been too early, and I've had the position on. It's the market's been irrational and gone the wrong way, and I've had to stop out, and then the position comes good. There's countless times there. So you have to be prepared for that. You've always got to be finessing your execution. Some common errors are hesitation, not getting involved at all. You've done all the work, you don't put the trade on. Hesitation, absolutely, I've seen that so many times, and it ends careers. And I've worked with so many good traders that great identifying, great preparation. When it comes to executing, just can't we say pull the trigger? Sort of isn't an analogy there. You see a lot of that hesitation, and it just those people do come on to be very good analysts. A lot of them that I've trained over the years, because that is a separate role. As a trader, you've got several roles. One of them is an analyst, a risk manager, an economist, and but if you can't be that execution, your own execution broker almost, then all that hesitation and all that work is going to stop you getting you where you need to be. Overconfidence, again, it's a fine line. You've got to have confidence, and you've got to have hope and optimism as a trader. But it's like with any trait, too much of it is no good. Too much of a good thing can end up being a bad thing, right? So you've got to balance that confidence. Make sure you don't become overconfident. It kind of blinds your process. Revenge trading, I see this a lot. Maybe you hesitate, you didn't put a trade on, and the trade comes in, and then your next trade, you're trading, you're pushing yourself and you're putting a trade on, and it's not quite the trade you should have done. And it's kind of revenge trading because you're trying to search for trades that are lower quality that aren't really there to do. And then you've got over trading. I'd say over trading and hesitation are the two biggest failure points that I've seen from traders. Those that just try and trade almost every price and push themselves too hard and, don't get anywhere. And those that just hesitate and don't trade at all. You got to find that happy medium for yourself, right? And it comes from having good process and a plan. Process over outcome always. Good execution can still be a losing trade. Bad execution can still be a winning trade. We are looking for good process that can be consistent, sustainable, and create that disciplined relationship with the markets. The massive takeaway from this, as we're on execution, is practice on the simulator. There's so many market simulators out there: crypto, TradFi, CFD spread betting. All of these apps and websites, they'll have a simulator or paper trading as an option, and 100% you need to be doing that. So there we go. Module number 7 done and dusted, and it was a big one. Trade execution. Traders really are made in the execution and management phase. So many traders I've lost to the wayside because they're great analysts, but they just can't execute. And there's the basics of execution. You've got now: entry, exit, stop. All 3 pillars, super vital for your practice moving forward. And when it comes to practice, make sure you use that simulator. I cannot stress this enough, how important it is to test ideas and everything you learn on a simulator first. Okay? We do it in the professional world, have traders on simulators before they go into the live market. Should be no different for you at home. Okay? So thanks for showing up and look forward to seeing you on the next video. Okay? Stay lucky all.